In this video, John answers a community member question. How do you best manage a large account? Is it different than managing one that is small? Listen up. For those serious about becoming successful, consistently profitable options traders, now is the time to build skills in technical analysis, market analysis, and applied volatility to get those results. We have multiple memberships, starting with our Go membership that teaches rules-based trading and our Pro membership that teaches more subjective trading. For more information, go to lockeinyoursuccess.com/memberships.
I was wanting your thoughts on how you personally would manage large accounts like 25 million. Very broad question, so how you feel appropriate, but wanted your thoughts on how you would allocate equity versus options versus futures, whatever, and position size. Would be the simplest way to structure things as far as potential adjustments go. I realize environment matters, so let's assume you're starting today, entering a period of volatility such as pre-COVID, right? This is not a simple answer, and it's not an answer that would go to every person. It would be highly specific on your skill level. It would be highly specific on, 25 million might be your account size, but what's your net worth? Is it, you could have a $25 million account with a $10 million net worth by being heavily financed on certain things and overfinanced and leveraged, or you could have $25 million account and have $100 million in net worth, which makes the account itself not all that significant. It's only 25% of your net worth. So there's a lot of things going on there, but in general, we talk about market outlook. Where you should be positioned is highly dependent on where the market is. So if I'm just going to go, let me just go to like a 20-year weekly chart for a second. We know when the market's overextended, let's go to SPX. When the market's overextended and high, you want to be light on equities, right? When everybody's euphoric and thinking the market's going to go up forever, you want to be light on equities. Anytime there's a major event or a major down move, you want to get heavy into equities. You want to be able to have the cash available to do that. So up in here, you should be heavy on cash. Up in here, if anything, you should be leveraged. You should be full in or heavily in anything long, right? We come in, we have our price patterns. We bring our price patterns out. Again, we get dips. We can buy dips. But you can see here, like if you just take this last COVID example, and we'll talk real time because we talked about this during market outlook, right? So we had market outlook back here. And you can see when the market was down here, this very week, I was talking about piling into long positions. And my long positions were not necessarily option positions because that has a time frame related to it. It's a good value. Stocks are a good value here. You want to buy them, right? Then you have the pattern that plays out. That's normal. But you want to be long here, you want to be long here, and then we have price pattern projection targets, right? So our price pattern projection targets puts us in a topping out range of the market here. We want to start lightening up on equities here. By the time we hit this 200% rate, this yellow area here, and this was all in play, by the way, before the moves. You can go back to our past market outlooks and see it. I was talking about starting to lighten up here, and then when we're up in here in this level, being out of equities mostly. You always want to have some equities in because you never know, the market may keep going up, but being mostly out of equities at this point, we knew the market was going to reset somewhere down into this range here. We want to start collecting equities down in this range. And now here we're setting in another pattern, and likely we're going to break out, and we can set a projection as to where this is going to go once it does. We may be sideways for maybe the rest of this year, maybe a little bit up, but we break out higher, and then we want to be aware of where our price pattern targets are to lighten up, and that's going to be fluctuating back and forth, right? I mean, think of what would happen if you put every dime you had in equities at this point, and then the end of 2021, or during the year 21, you're scaling out of them, and then you scale back into them down here. It's very high probability moves in the marketplace. It's pretty much what should have happened in the marketplace. You want to do that, but as you're topping out, you can start getting into neutral things, right? So you do not want to do covered calls here, right? You want to be in you don't want to do naked puts so that you can pick up stuff if the market continues down. You can pick up stuff at a better rate. You get paid really well for naked puts, but naked puts with the intention of buying. You want to get here. You don't want to do any kind of covered calls here. You might want to do it at the consolidation that's likely to happen here, right? So we got this, when we hit this new high, we're likely to go into a consolidation pattern. You could maybe do it there, but once we broke out of the pattern, you do not want to be in covered calls again, right? Because covered calls it caps your profits on stock, and you don't want to be in a position where you're going to cap your profits on stock if the market's likely to go here. Once we get up into here, boom, you want to start doing your covered calls again, right? Covered calls, covered calls, covered calls, covered calls. Neutral strategies that take on risk to the upside of the marketplace. Basically anything more towards bearish up in here. Anything, if you get into option strategies, super bulls are very good in this environment. If it's volatile, you don't want a regular bull, you want a super bull. If it's not volatile, a regular bull is fine. You want to get into your bear trades as you come up get ranged up into this range here. Bearish butterflies, so forth, all in through here. And then, of course, once the market bottomed and we set in this area here, you kind of want to be out of your bearish trades because now we have all the signals that the market's going to try and recapture this level up in here, at least possibly all-time highs. So your strategy ideally is going to vary depending on what the market's doing. If you can do that, if you can maximize it, that's where the great wealth is made, right? And also remember, cash is a position. You can be in cash. We have certain types of market environments like 2018 where you didn't want to be in equities and you really didn't want to be in any kind of neutral options position. Realistically, it was a good time for cash, and you could tell that by when you set up your positions. It was no good. I don't want to be in options positions when it's no good. I want to be in options positions when my probabilities are high. I want to be in options positions when the price is likely to be range bound. Unless I'm, that's true even if I'm open to the upside, right? So if I do an M3.4U's, my normal strategy, for example, I don't want to be doing those down here because, an M3.4U is not going to lose in this, but it's not the best trade to be in because you're not going to make all the money associated with the gain. When I start to top out here, I want to be an M3.4U. We're generally bullish in the marketplace, and the market's likely to go up. That strategy represents that opinion. So I can do that. When I break out, I want to be long again. When I get back up in here, I want to be an M3.4U. When I get back into here, I want to be in more bearish positions, at least until we get down and retest here, right? Because this is you guys should be able to see this pretty clear when you look at it, right? We had a pattern put in here. We had a range of consolidation at the top of the pattern. It gives us a low target here and a high target here. This is times I sell your equities, right? This red's been marked out for years now. That's the time to sell your equities. We get back in here. This is back in your green zone again to be long again in the market. And during this whole period, you can apply the appropriate strategy depending on where things are, what's likely to happen with things, and what your implied volatility is doing. Because implied volatility is your key. We trade implied as a condor trader, a Brooklyn Wing butterfly trader, a calendar trader. We trade implied volatility. We don't trade theta. We trade implied volatility. Your success is going to be determined on a combination of what implied volatility is doing and a combination of what the price movement's doing. Either one of those can take you out. Either one of those can win you the trade. So that understanding is something that you should understand gain or aspire to gain a deep understanding of that. If you do that, you can, like I said, be very, very effective with your decision making on what's likely to happen.